Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is May 14th, 2025, and we're diving into Gevo's first quarter earnings report for 2025. Joining us is John, a senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Gevo, a leader in renewable hydrocarbon fuels, has just released their Q1 2025 earnings, and there's a lot to unpack, from revenue growth to strategic initiatives.
Revenue and profitability overview. Let's start with the top line. Gevo reported a significant increase in operating revenue, up by $25 million compared to the first quarter of 2024. John, what are the key drivers behind this growth?
The revenue boost is primarily due to the acquisition of Red Trail Energy, which contributed $23 million in inorganic growth. Additionally, their RNG project saw a 42% increase in revenue thanks to a favorable carbon intensity score from the California Air Resources Board.
Despite the revenue growth, Gevo reported a net loss per share of 9 cents. How does this compare to analyst expectations?
Interestingly, the reported EPS of actually beat the forecasted EPS of Dent, which was based on a survey of 2 analysts. This indicates a slightly better performance than anticipated, despite the overall loss.
Strategic initiatives and market expansion. Gevo has been active on the strategic front, particularly with new offtake agreements. Can you elaborate on these initiatives?
Absolutely. Gevo signed a significant agreement with Future Energy Global for emissions credits from 10 million gallons of fuel. They also secured another agreement for 5 million gallons of SAF. These deals are crucial for financing their alcohol-to-jet projects in the Dakotas.
And what about their Verity platform?
Verity is Gevo's data verification platform, which recently onboarded 2 new customers. This platform is pivotal for tracking carbon abatement and ensuring compliance, which is increasingly important in today's regulatory environment.
Operational efficiencies and future outlook. Operational costs have risen significantly. What are the implications of this for Gevo?
The increase in production costs, primarily due to the acquisition of Gevo North Dakota, is a double-edged sword. While it raises expenses, it also positions Gevo to capitalize on future revenue streams from ethanol and carbon abatement.
Dr. Patrick Gruber, Gevo's CEO, mentioned expectations for positive Adjusted EBITDA this year. How realistic is this outlook?
Dr. Gruber is optimistic, citing the monetization of tax credits and the strategic positioning of their North Dakota plant. The anticipated growth in SAF demand further supports this positive outlook.
Key takeaways. In summary, Gevo's Q1 2025 results show promising revenue growth and strategic advancements despite ongoing challenges. John, any final thoughts on Gevo's investment prospects?
Gevo is well positioned in the renewable energy sector with strong strategic initiatives and a focus on carbon abatement. Investors should watch their progress towards positive Adjusted EBITDA and the expansion of their SAF projects.
Thank you, John, for your insights. And thank you to our viewers for tuning in. Don't forget to like, share, and subscribe to Smart Stock Watch. We'd love to hear your thoughts on Gevo's performance in the comments below.